Yesterday, the Indian stock market faced intense downward pressure. Aggressive selling took over, driven by a wave of widespread fear among traders. That panic stemmed from two massive global threats. Tensions between the US and Iran spiked, and as a direct result, global crude oil prices surged. But today, the momentum flipped. This line chart shows how sharp that reversal was. After yesterday's steep decline, the market shot up into a green peak, with Sensex closing 238 points higher at 76,742, and Nifty jumping 81 points to 23,963. For anyone trading with their own money, a 24-hour whiplash like this raises a difficult question. Is it safe to start buying again, or is this early momentum a false start? Surviving this level of volatility requires analyzing the specific mechanics that drove the bounce, rather than just reacting to the index colors. The biggest relief came from overseas. The immediate threat of a broader conflict between the US and Iran simply did not materialize overnight. Without that escalation, the anxiety surrounding global energy routes eased. That pause stabilized the volatile crude oil markets. Since India relies heavily on imported oil, removing that massive cost pressure gave domestic buyers the confidence to step back onto the trading floor. There was a second, quieter force supporting the market today: foreign institutional investors, or FAIs. Today's recovery reflects a combination of geopolitical relief and opportunistic foreign capital, rather than a shift in domestic economic fundamentals. While macro forces set the floor, specific sectors drove the actual gains. Today, the spotlight was entirely on the tech sector, specifically Tata Consultancy Services. TCS released their Q1 results after the bell, and their revenue comfortably beat market expectations. The primary driver for that growth was expansion in their artificial intelligence business. Those strong numbers from TCS acted as a positive signal for the broader IT landscape, injecting confidence across the sector. That confidence spilled over. Pharma, healthcare, mid-cap, and small-cap stocks all followed the upward trend today. Despite the broad sector gains, Dr. Reddy's Laboratories broke from the trend, crashing by more than 5%. The cause of the drop was highly specific. The company is facing severe manufacturing and supply chain bottlenecks that are restricting their operations. A broad macroeconomic market rally might lift the overall index, but it cannot erase the core operational failures of individual companies. Closing in the green offers obvious psychological relief, but the market is currently navigating a volatility paradox. The data shows that a single day of upward momentum does not indicate that the overarching bearish trend has reversed. The market remains balanced on a knife edge. The next few trading sessions will act as critical stress tests for the resilience of the entire Indian economy. Tomorrow, external data is paramount. You need to track real-time fluctuations in crude oil prices and any geopolitical updates involving the US and Iran. Internally, watch how the broader market reacts at the opening bell to the TCS results. We also have upcoming earnings reports from Infosys and HCL Tech that will further test the IT sector's strength. Navigating an unpredictable market requires constant vigilance and cold data analysis, rather than relying on optimism from one good day. If you want to stay ahead of these shifts, subscribe to the channel, hit the like button, and share your own market predictions in the comments. We will keep bringing you these daily tactical updates in Tamil.